In March 2025, the S&P 500 dropped 10% in 3 weeks. In April, it dropped another 15% in 4 days. By the time most people realized what was happening, trillions of dollars in retirement savings had already evaporated from 401k accounts across the country. Not from fraud, not from a banking collapse, from tariffs. From a trade policy decision made in Washington that most financial advisors never modeled into a retirement projection. Here is what I want you to understand before anything else. Tariffs are not just an economic headline. When tariffs are aggressive enough and broad enough, they function as a direct tax on corporate earnings, a driver of inflation, and a trigger for market repricing, all three simultaneously. And all three of those effects land directly in your 401k, not eventually. Now, my name is Ben. I have spent the last several weeks going through earnings reports, Federal Reserve commentary, and historical data on how equity markets have responded to tariff regimes going back to the Smoot-Hawley Act of 1930. What that research shows is this. The current tariff environment is creating a specific type of retirement account damage that is different from a normal market correction, and that requires a specific response that most people are not making because they do not understand the mechanism. By the end of this video, you will understand exactly how tariffs flow through corporate earnings into your 401k balance, why this downturn is structurally different from 2020 or 2022, what the historical data says about how long tariff-driven disruptions last, and what specific actions actually protect retirement savings right now versus actions that make things permanently worse. Because the worst thing you can do right now is the thing that feels most logical. And millions of Americans are doing it. Here is the mechanism most people are missing. When most people think about tariffs and the stock market, they think one level deep. Tariffs raise costs, companies earn less, stock price falls. Simple. But here is what actually happens across 3 levels simultaneously. Level 1 is the direct earnings hit. Companies that rely on imported components face immediate cost increases. If a company was importing $2 billion in components at 10% and that rate goes to 25%, input costs jump by $300 million, straight out of earnings. Most cannot fully pass this on to consumers, so earnings fall. Stock prices reprice downward. Your 401k falls with them. Level 2 is the inflation effect. The costs companies do pass on show up as price increases. Inflation rises. The Federal Reserve faces a dilemma. Cut rates to support the economy and risk letting inflation run hot. Hold rates high to fight inflation and slow growth further. This is called stagflation, simultaneous slow growth and high inflation. And it is the worst possible environment for a standard 60-40 retirement portfolio. Stocks fall because earnings are under pressure. Bonds underperform because inflation keeps rates elevated. Both halves of the traditional retirement portfolio get hit at the same time. Level 3 is the confidence effect. Markets price what companies are expected to earn over the next several years. When tariff policy is unpredictable, when rates can change with 24 hours notice, companies cannot plan. They delay investment. They slow hiring. This uncertainty gets priced into valuations as a discount. Even if tariffs were removed tomorrow, the damage to business confidence takes time to unwind. This is why tariff-driven disruptions tend to be stickier than corrections driven by short-term sentiment. Now, the specific numbers. Say you had $400,000 in your 401k in January 2025. A standard target date fund for someone retiring in 2030 holds roughly 60% equities and 40% bonds. The equity portion, $240,000, is heavily weighted toward U.S. large cap stocks. In the S&P 500 decline of early 2025, that $240,000 lost roughly 15 to 20%, a loss of $36,000 to $48,000. Your bond allocation, meant to cushion the blow, provided limited protection because inflation concerns kept bond prices suppressed. Your total account may have dropped to $350,000. That is a $50,000 loss in under 90 days. Not because you made a bad investment decision, because a tariff rate changed. Here is where it becomes permanently damaging for people close to retirement. If you are 62 and planning to retire at 65, a $400,000 account growing at 7% over 3 years becomes roughly $490,000 at retirement. A $350,000 account growing at 7% becomes roughly $428,000. That $50,000 lost today becomes a $62,000 difference in your retirement balance, and then a permanent reduction in annual withdrawal capacity for the rest of your life. Using the 4% rule, the difference is $2, $480 per year less in retirement income every single year until you die. That is the real cost of this correction for someone close to retirement, not the paper loss. The permanent compounding effect on future income. Now, the mistake millions of Americans are making right now. When markets fall sharply, the instinct is to move to cash. Stop the bleeding. Wait until things stabilize. This feels logical. It is psychologically compelling. And it is almost always exactly the wrong move. Nobody rings a bell at the bottom. Nobody sends a notification when the market has finished falling and is about to recover. The recovery from a tariff-driven decline, like the recovery from the 2018 and 2019 trade war, which produced an initial sharp decline followed by resolution and recovery, tends to be fast and front-loaded. Most recovery gains happen in the first few weeks after the low point. If you are sitting in cash, waiting for things to feel safe, you miss exactly the days that matter most. Research shows that missing just the 10 best market days between 2003 and 2023 cut total returns in half, compared to staying fully invested through the entire period. The people who move to cash lock in their losses permanently. The people who stay invested capture the full recovery. So what should you actually do right now? Specifically, in a tariff-driven market disruption with inflation concerns and policy uncertainty. First, do not move to cash if your retirement timeline is more than 5 years away. The math does not support it. The emotional case for moving to cash is always compelling in a downturn. The mathematical case almost never is. Second, if you are within 3 years of retirement, this is the sequence of returns risk window. If you have not already reduced equity exposure to match your actual time horizon, review that allocation now, not to flee to cash entirely, but to ensure you are not carrying 80% equities when you have 30 months until withdrawal begins. Third, keep contributing. If you are still working and contributing to your 401k, a market downturn is a gift for your long-term outcome. Every contribution you make at current prices is buying more shares at a discount. When prices recover, and historically they do, those extra shares amplify your gains. Stopping contributions during a downturn and resuming after the recovery is exactly what produces the worst long-term outcomes. Fourth, do not confuse uncertainty with permanent loss. Tariff policies change, trade negotiations happen. The underlying earnings power of American corporations does not disappear because of a tariff rate. The market is repricing for uncertainty. When uncertainty resolves, even partially, the repricing reverses. Your job is to still be in the market when that happens. The most expensive financial mistakes in history were not made during market crashes. They were made in response to market crashes. The people who permanently destroyed their retirement outcomes were not the ones who experienced the downturn. They were the ones who panicked in the middle of it, sold at the bottom, and missed the recovery. The tariff-driven disruption of 2025 and 2026 is real. The damage to your current balance is real. But whether that damage becomes permanent depends entirely on what you do next. Stay invested, keep contributing, understand the mechanism, and do not let a policy decision made in Washington destroy a retirement plan built over decades.